Good afternoon. I'm Jason Brown, the lead advisor manager here at Foster Group.
And I'm Kent Kramer, the Chief Investment Officer at Foster Group.
And we want to welcome you on this beautiful November 5th day, at least for Iowa. Hard to believe. I doubt I'd be wearing this sweater if I weren't in front of a camera right now.
That's beautiful.
Yeah, so welcome to Elections and Your Money, Part 2. This is kind of our post-election version of this webinar. And, Kent, we here at Foster Group, we want to help our clients live lives of meaning and generosity. And we do this by planning, investing, protecting, and giving alongside of them. And a few housekeeping items before we get into the Q&A session of this webinar. First of all, it's scheduled to last about 30 minutes. We may go longer than that, but we're not going to obligate you to that. You can leave after 30 minutes. It's also being recorded, and there'll be a link to it in our November 10th e-newsletter. And then on the bottom of your screen, there's actually a Q&A button. So if you've got a question that comes to mind at any point, go ahead and hit that, and you can submit those questions, and we'll do our best to get to them. If we don't get to your question today, we're going to try and get to all of those after the webinar via email. So anyway, Kent, you and I now have been prepping for the last hour, so I'll ask a question that I think most of our viewers probably have a better answer to. Where do things stand?
Yeah, right. I was thinking about that when you asked me that question, and I realized you're probably watching, many of you, if you're watching this, you might have your screen actually split right now between our webinar and what's going on with the news, because everybody's kind of waiting to see like where things in Nevada are going to land, where things in Georgia, North Carolina, some of these places that are still out in terms of final result. But it looks like, and I think the odds are pretty good, it looks like that we're going to have a President Biden and a Vice President Harris when the dust all settles. There's going to be what we thought a contested election in terms of there's going to be some court things filed. But really, the numbers would say nationally, I think that the overwhelming likelihood is that Vice President Biden has won, and that he will be the next president of the United States. It's a little less certain in terms of the Senate. It looks like Republicans are going to hold on to the majority there, maybe with a razor-thin majority. Georgia is kind of a funny state in that way, because to be elected as a senator from the state of Georgia, you have to receive 50% or more of the vote. And so for sure, there's going to be one runoff election in the first week of January. Yeah. And Senator Perdue, or the senator who's on the ballot, last time I looked, he had 50% of the vote, the Republican. And so, he's kind of on a razor-thin margin, too, as to whether or not there's going to be another, maybe two special elections in January for Georgia.
And if that happens, God bless the people of Georgia.
Yeah.
Holy mackerel, have we been through kind of a commercial season here in Iowa.
Your economy, at least as the television stations there, are going to make money hand over fist in Georgia if that's the case, because it will be an unbelievable amount of money that will be spent, particularly because if the Republicans have 50, and those are the only two left, then if the Democrats can pick up the other two to get to 50-50 in the Senate and have the vice president as the tiebreaker, then that really puts them in control.
You've heard the phrase, money is no obstacle.
Yeah.
Before. It won't be an obstacle to spending in that state.
That's right.
So, Kent, one of the things that is interesting to me, a lot of volatility leading up to the election in the market. Then suddenly, like we went up, kind of sprung up 2 days before, had the election. Now we've had two kind of really good days the last 2 days.
Yeah.
I was a little bit surprised by that, but maybe you can help me understand it more.
Yeah. So we talked about, one of the Foster Group investment principles is this idea of embracing uncertainty. And the markets, to some degree, rely on uncertainty. There needs to be a little bit of risk, or there's no reason to think that you're going to have a positive return. You have to be willing to take some risk over some period of time. And in exchange for that risk, you get some return. So there's a bit of uncertainty, right? That's part of what generates return, is accepting a degree of uncertainty. At some point, too much uncertainty makes the market really want to go down. People can get pessimistic.
Yeah.
What I think has happened here is the range of expectations coming into the election. So think about what they were. We kind of expected a contested election.
Yep.
There was some expectation that it would be close. 2016 was certainly close. You and I talked about that, even though the polls made it look like this might be a larger Democrat win than 2016.
I think people were probably very suspicious of the polls.
Exactly.
Yeah.
So that was already kind of built in, like, well, it could be close.
Yep.
We could have either president. We could have a divided Congress or not. What happened is the results that we're seeing are all within the range of expectation. Though we didn't know necessarily who was going to win the presidency, we didn't know necessarily who was going to win the Senate. The range of what was going to happen, we're well within that range. We're actually almost right down the center in terms of what people thought might happen, which from the market perspective is a positive, because the kinds of surprises that make the market go down are negative things that were kind of not in view. So think coronavirus, a negative thing. Nobody saw that coming. And wow, when it hit, it took markets down because it was a big negative surprise that came out of nowhere.
Yeah.
There's nothing like that in this election.
So yeah,
at least to date.
As I think about what you just said there, I'm thinking even just about a text stream with my friends, and one threw out ahead of time. So what do you think is going to happen? And people said, maybe Biden's going to win, maybe Trump's going to win. We suspect we won't know the outcome until Friday or Saturday. We suspect there could be litigation on either side. So yeah, I guess in some ways we're getting what we expected,
We're
and
right
markets
there.
like that.
And markets like that, yeah. And I was laughing because, many of you are reading the same media or news sources that we read. And what strikes me is, actually, I was on a call with some strategy people from BlackRock this morning. And, everybody had a narrative of what was going to be good for the market going into the election, right? So some people would say, well, the blue wave would be great for the market because that means that we'll get big fiscal stimulus passed. A lot of money will pour into the economy. That's going to put money in consumers' pockets. They're going to spend it. It's going to drive up economic activity. This is going to be great for the economy. Okay, that's one narrative. And people were kind of saying that's why you saw this big positive move 2 days in front of the election. Now, though, we're on the backside. It's like, okay, no big blue wave. Instead, we're going to have divided government, fairly close, probably not going to have big tax changes if things stay that way. We may have less fiscal spending if Republicans remain in control of the Senate, although Senator McConnell has already said that he would like to do something in terms of fiscal policy before the inauguration. He wants to take some action in December. So the idea there is that's another narrative. People are going, well, this is good for the market because what we've had is now going to be what we're likely going to keep. So which narrative is it? And what I like to say is oftentimes there are narratives that are in search of facts. We have biases. That's the story that we like.
I don't.
Okay. All right. I'll speak for myself. I have them. But we have these biases and they're kind of in search of a fact to back up my story.
Do it all the time. Yeah.
So I think that's largely what's happening with the stories in the news right now. The biggest story, I think, though, is that the range of expectations in terms of what we thought might happen with the election, they're well within the range of expectation.
So another thing that you've talked about before, and then I've read subsequently, is just the markets are not as tied to presidents as what the president, when markets are doing what they normally do, which is go up, would like us to think, or that the president's people would like us to think. That's right.
Yeah, that's really true. Presidential elections are, well, there are many things, but they are also very symbolic, right? I mean, it feels like we're almost, in the way that the world works right now, it feels like we're in a presidential election cycle all the time. We're either leading up to an election or we're just coming out of an election, preparing for the next one. So you can bet that as soon as the dust settles on this one, the Republicans who will be challenging likely President Biden, they will start to be in Iowa. I would guess before, early on in 2021, we'll have visitors in the state of Iowa who will be running for president on the Republican side in the 24 election. So, we'll see. But the idea that the presidential elections are largely symbolic, that's important. There's lots of policy things in the line with the presidential election. But in terms of how the market responds and what happens in the economy, it is one part among hundreds of other parts that influence economic activity and what's happening with the health of companies and consumers and all those things that really, really matter in terms of the kind of health of our economy and markets.
So whenever anything momentous happens, we we ask the question, so what should we do? And even though we just maybe talked about perhaps this is not quite as momentous as we like to think it is or make it
Yeah.
is in regards to the market, what should we do, Kent?
Yeah. So probably the one thing we should not do is to be looking for investment advice from people on television who are commenting on what the meaning of this election is and what markets are going to do, making predictions without a lot of knowledge. You know, they're on there to make predictions and to say things because they're trying to get attention, just like before the election and after the election.
And
Many
they're
of the
trying to
folks
get
on television-
attention.
via fear or greed, really. So
Yeah.
think about it. If we'd had something outside the range of expectations with this election, the news stories would have been fear-based stories. Hey, this is going down. It's going to keep going down because this is a horrible outcome. Right. What's happened though, instead, is markets have been going up. So now the other story is, right, these stories in search of facts. They're saying, why are they going up? I'm going to tell you why I think they're going up, and therefore why you should be investing more because they're going to keep going up.
Yeah.
If that's the narrative. So it's this appeal to greed to participate when really what's happening is in every presidential election, one of our advisors sent you and I the same article about how volatility increases in kind of the week leading up to a presidential election and the week coming out of a presidential election because we're all paying attention to it.
Yes.
But then after that period, it just kind of dies down and goes back to normal.
Yeah.
So to make an investment decision based on this kind of volatility or action, or to listen to someone on television who doesn't know you and your personal circumstances at all, and to try to make a decision that way seems to be really counterproductive.
Don't do that. Well, and so you said I was on the phone earlier today, or was it earlier this week,
earlier
with
today.
somebody from BlackRock.
Yep.
Okay. So maybe what do we do might be a question like, okay,
Yeah.
so because we are investors as well, we invest a lot of people's money, including our own.
Yes.
What do we do? And
Yeah.
is it specific to what's happening now, or what should we always be doing as an investor?
So that last question, what should we always be doing, is really, I think, such a good question. It's something that we try to do here, that I try to do, and that is to keep learning. I think this idea that somehow we have a fixed universe of information and that nothing ever changes, that's just not true.
Yeah.
Right. There are a lot of things that change all the time. So I think any good investor is continuing to learn, is continuing to be curious, is continuing to ask questions. That's why we were on the phone with BlackRock this morning. They have a view about markets. They have views about where things might go in the future. Had a lengthy discussion about interest rates.
Yeah.
In terms of where they might go. They're so low right now. It doesn't seem like they can go lower, but of course they can go lower, right? So the question is, what's the probability of them going lower or higher? And can you predict that? Our view is very hard to predict, especially in the near term, what's going to happen. So we don't really want to respond to that. But the idea of continuing to learn, maybe for a couple different reasons. One is to test your foundational assumptions. Is what I believe about the world still generally true? Right? Long term.
That's right.
And then the other thing is to say, well, maybe there's something new or something that would slightly alter kind of my view. Either way, I think the idea there is, as an informed investor, if you have information that's valid, you can find it confirmed in multiple sources, makes economic sense, well, then maybe there's something that we might do incrementally different or take a look at differently. But learning is the thing, not reacting to people who are telling you what to do when they don't know you at all. Those things you really want to be careful of.
Yeah. Some of what I hear you saying too is, listen to experts, pay attention to experts. We'd like to think we have some, expertise when it comes. Listen to those people who are not alarmists, who are not short-term thinkers, who are long-term.
Mm-hmm.
Pay attention to those. And what strikes me, it's in those moments when we are most tempted to think short-term, that we probably need to say, okay, take the long view.
And listen to the people who have a combination of learning information, who know your situation, and who have your best interest in mind. Now, it's hard to have your best interest in mind if they don't know you. So that combination is pretty important.
Yeah.
And then a degree, I think, of humility, in terms of saying, to me, humility is always a good sign, because usually a humble person is willing to learn something.
Right.
And I think you want to be in that position. This election cycle has had a lot of opportunities to learn or to think about whether you're on the right or the left, to try to understand, why does the other side not like my position?
Yes.
And until you ask that question, it's going to be hard to persuade the other side, because you're not going to understand what it is that they don't like about your position.
Yeah.
I just think there's a lot to be said, and maybe both parties coming out of this, we can always be hopeful. Maybe both sides will take a little bit of a humble posture and say, what can I learn about why we're so divided and why it seems like so polarized on the edges? What is it about our message, or what people are perceiving about our message, that is frightening to the other side? And what can I learn from that?
Yeah. And, if you take away those extremes, I think I really have had. I was in a book club last night with people who think, in many respects, very differently from me. And they are good people.
Mhm.
And I can have sort of my thoughts, but then when I bring it to them, I find that they have more reasonable answers than I'm answering in my own brain.
Yeah.
I have friends who voted for Trump. I have friends who voted for Biden. And when I take time to actually listen to their whys, they all have reasonable things to say.
Mhm.
Very difficult to admit that.
Yeah.
Or to allow for that.
Yep.
But maybe, hopefully, we could do more of that.
Mhm.
Anyway, that's
hope
an
so.
aside. Let's get to some of these questions here.
Absolutely.
So one of the questions that somebody wrote in is, what sectors now look best and why?
Yeah. So really popular question, because it seems like, yesterday, for example, technology stocks just really took off.
Yeah.
Now, the narrative behind that was, they think if Republicans are in charge of Congress, or at least have some influence, that the level of antitrust regulation or prosecutions against technology companies might actually go down, or not emerge, or be as tight. For some reason, they think, antitrust under Republicans is going to be more laissez-faire than under Democrats. I'm not sure how true that is, but that was a narrative that was floating around. So you might think, oh, well, let's
get in those.
Technology, right? The problem with that is technology has outperformed over the last 3 years. So they are the most expensive stocks in the market today. So you have to ask yourself, do I really want to be buying something that has already gone way up? I'm buying the most expensive thing in the market. Some of those companies probably will continue to do well, and their stock prices may go up. But for a lot of them, their stock price has gone up so much relative to their earnings and their book value and those things. At this point, the people who are setting prices on those stocks are really short-term investors. Many of them are kind of thinking, where's the stock price going to be in a week or in a month? And if I buy it today, can I get out of it at a higher price in the future? Not so much about, where's the stock price going to be in 5 years from now?
Yeah.
If you're a 5 years from now investor, I'm not sure that buying the most expensive thing in the market is really a sensitive approach or a sensible approach. There's a number of parts of the economy that are so highly related to, let's say, the recovery from the virus. So think about the entertainment industry, the travel industry, think about certain service parts of the economy. They are absolutely beaten down, and their valuations are really low.
Mm-hmm.
So if we continue to have good progress towards a vaccine, end of the year, first quarter, middle of next year, those value stocks that have just been kind of languishing behind these fast running technology stocks, the cyclicality of markets would say, there's a good chance that those stocks will now start to really catch up and grow faster, stock price wise, than the technology stocks that have kind of had a great stock price run.
So maybe something that I'm thinking of is, what's a better question to ask, perhaps, than what sector should I try and get into or avoid? Is there a better question or a better,
Well, the first question you might want to ask is, do I really think that I have unique knowledge that other investors don't have? Because in order for me to say, well, this sector is a relative buy, in other words, I think this sector is undervalued relative to where it's going to be, well, you're kind of trading that view with somebody else in the market who has a different view. So if you're buying at today's price, you're saying, hey, I think the future expected return of this thing is relatively good. The person who's selling at that price is kind of on the other side of that coin, right? So you have to ask, do I really have any special knowledge? I think for most investors, and certainly this is the way I think about it and the way Foster Group invests, is we look at the market as a very efficient pricing mechanism. It reflects the expectations of literally millions of investors, many of whom are large institutions. So the prices in today's market reflect kind of an expected return over some period of time. To me, that argues for, I think the market's a pretty good place to start. So I'm going to start my portfolio with the market, which means I would just like to own the market as a whole, because I don't know that I have any special knowledge. And then if I can learn some things historically about which kinds of companies or stocks have tended to do better over longer periods of time, if that's my time horizon, then maybe I would slightly overweight my portfolio towards those things. Well, right now, again, value stocks, they are at a historic low price relative to growth stocks. And that's been kind of painful if you've been a value investor for the last 3 years.
As I have been.
That's, me too, because that spread is historically wide.
Yeah.
But if in the long term, you think price matters and, what
Math
a company's
matters.
worth, math, all those kinds of things, you'd say, two things. One is, I don't think it's a great time to buy the highest price thing, technology. And maybe the thing is, I should be hanging on to those low price things, because once this cycle starts to reverse, and historically it has done that, there's no guarantee it'll do it every time or when, but when that reverses, those value stocks should do quite well. Same thing with US to foreign stocks. We've kind of seen this a little bit in China, for example. Their economy is recovering a little bit faster than ours for a variety of reasons, but their stock market has begun to really rise. Emerging markets have really begun to rise. Well, if I'm a diversified investor and I held those investments, then I was present as they started to go up. I talk about people needing to be present to win. To me, it's like when you try to make a sector bet, I'll say, it's a little bit of a risk. Now, some people, they may want to have a part of their portfolio to do that with. I kind of call it the casino account for some people.
Well, yeah,
because it's fun, it's interesting, it scratches an itch, it lets us, kind of express an opinion. The thing there I would say is make sure that's a relatively small part of your portfolio. But, people can certainly do that. But I think with the bulk of their portfolio, you want to be a long-term, widely diversified investor and really not pay a ton of attention to that in terms of how you feel each day, because that's set up to meet goals that are many years in advance.
Right. Another question that somebody wrote in is, during these uncertain times, what are your thoughts about gold? So they want to hear from you, Kent.
Yeah, so I have a facetious answer to that question and a serious answer.
Go ahead and give us the facetious answer.
Okay, the facetious answer is, if you like jewelry, good for you. I mean, that gold makes great jewelry. And
okay, strike that from the record.
Although I have to tell you that in my household, I made a mistake one time and I bought what I thought was a very nice piece of jewelry for my wife, and she was just not impressed. So I learned from that. I go, okay, I guess that's not the love language there. So maybe that's not a good use for gold. So enough of that story. But the idea of gold as an investment in the portfolio, when people are looking at gold, they're generally using it as a hedge against something bad.
Yeah.
So when you think about a hedge, it's like, well, I'm going to hold this because I think there's something bad that could happen to, you can fill in the blank. So one blank that people fill in is, I think inflation might happen.
Okay.
So all this government spending, lots of debt being accumulated. It seems like maybe the dollar might be debased.
Yeah.
So if the dollar goes down, I want something that's not a dollar to hold my value. Maybe it's gold. Now, historically, gold has not correlated that well, especially in short terms, with inflation. But it kind of has that, I'm going to call it almost like a mythology, that somehow it's a inflation kind of a hedge. It hasn't really operated that way empirically, but people think that. If you really wanted to hedge against inflation, you might think about TIPS, Treasury Inflation Protected Securities. These government bonds issued by the US government, they adjust for the consumer price index every quarter. So if you're worried about inflation and you want to hedge against unexpected inflation, TIPS are going to follow inflation to a T. They're perfect. Now, gold also sometimes think about as a hedge against catastrophe.
Yeah.
Right. So if the end of the world, and there's lots of apocalyptic movies and things like that, seems like there's more of these all the time, but people begin to think in these apocalyptic kind of terms, and they go, well, if really everything goes down, gold, this physical thing, is something that doesn't go with the paper markets.
I could be protected.
Yeah, it might provide that. You and I were talking about this before. In that kind of a scenario, really the thing you're going to want is food, shelter, water. Gold.
And I was thinking some friends too.
Yeah, and this is where I think Iowa farmers are like, they are going to be in the catbird seat if that happens, because they have access to all three of those things. They can produce the food, they have shelter, and they've got water on their land. Yeah. That's a nice spot to be. But gold to me is one of those ones where it's a very, very speculative investment. It doesn't produce any income. There's no productivity associated with it. But because there's a large group of people who are willing to speculate with gold, its value goes up and down. I just don't know that it has a really sensible place in a portfolio. But again, kind of like that casino account, if it's a very small part of what a person wants to do, kind of on their own, as just a way to scratch that itch, makes them feel better, it's not going to harm someone when it's in a very, very small amount of their portfolio. You could say the same thing about Bitcoin. I think that's another one that's gotten a lot of attention. People think, hey, if the dollar gets debased, what if I own some Bitcoin? Same idea. It's really, really speculative store of value. There's some interesting stories around it, but you would not want to make that a significant part of your investment portfolio at all. It's really a speculative idea.
Well, thank you for that. And, it's tough to you were pretty forthright there.
Well,
you were asked.
I was asked about gold. And so
yes.
The thing that I've learned, I probably continue to learn, is that markets will always come back to humble you.
Yeah.
Prices will humble you from time to time. Gold's had a very good 18-month period. It's done well. It did not do well for 15 years prior to that. Will it do well again in the future? Probably will, as long as there's a number of people who think it's a hedge. But I don't know, again, that it's really a great long-term hold for a portfolio.
So I want to ask you a couple more questions, and then I want to kind of do a formal close.
Okay.
But I have another question for you after that for anybody who wants to stick around. But so there was some questions around, you talked about interest rates, so you mentioned that. And then you also just mentioned inflation. Any concerns about either interest rates or inflation that we should be aware of as investors?
Yeah. So we're in obviously a very, very low interest rate environment. Oftentimes interest rates and inflation, there's a relationship between them. So inflation has been very low. Interest rates are really low. The Federal Reserve has looked at that and said, we don't see inflation as a risk in the near-term environment. We're trying to stimulate the economy. So they've pushed in interest rates to historically low levels. And they've said that they intend to keep those interest rates low through 21 and into 22, maybe 2023. So they've kind of made their intentions very, very clear. Chairman Powell has said, we're not even thinking about raising interest rates, because we're just far away from that economically. We have to have a lot of other things recover before that. Now, that being said, if the economy were to recover rapidly, so in other words, there'd be a lot of economic activity, unemployment would go down, a lot of people would get their jobs back, if the health situation changes so people feel much more confident about their economic activity, then maybe you start to see some spending happen and you might just see some inflation emerge. But there's a lot of things that have to happen to push inflation to a uncomfortable level. I mean, we're running at less than 2.
And it's been low for
a very long time.
Yeah.
And again, if you look at the Treasury inflation protected securities market, the 10-year expectation for inflation is still under 2%, in terms of what the market thinks is going to happen. So the likelihood of near-term inflation of any large amount seems really unlikely. Now, there's a school of thought out there that would say, well, if the federal government passes a lot of fiscal stimulus, a lot of money gets into the economy, Yep. So people can spend it. So you have a lot more dollars chasing fewer goods that might, but we have so many people who are not working. We have so much capacity in factories that are not producing. There's a lot of things that would have to happen to drive up demand to the point where we couldn't keep up with it.
Yeah.
Which that's when you start to see inflation go. I mean, just look at the oil markets. The idea right now that we're going to have oil-based inflation. People who are drilling for oil and processing oil, they would love to have the demand for oil go up. But until we get this virus thing solved, people aren't traveling nearly as much. There just isn't the demand.
Yeah.
Ultimately, consumer demand has a lot to do with inflation. So I think, interest rates are likely to stay relatively low. Inflation is likely to stay relatively low, particularly the next 2-3 years. There doesn't seem to be any reason to think. But again, there's always a surprise out there waiting to happen. Don't want to totally negate it, sound like we know everything. But from what we can see today, that would be a lower list of the worry, I think.
Thanks, Kent. As I said, I've got another question for him, but I want to draw this to a close. So just a few items as we close today. First of all, this has been recorded, and we'll be sending out a link in our e-newsletter on November 10th. Secondly, for all of our clients who joined us today, thank you for being here, and also thank you for the opportunity to partner with you as you live lives of meaning and generosity. We're grateful for that opportunity and the trust that you place in us. And then finally, for those of you who are joining us who aren't clients, and if you'd like to have a conversation about anything that we talked about here today, or just about money, investing, planning in general, it's probably no secret that we would love to have that conversation with you. So you can do that by contacting us through the information that's going to be on the screen at the end of this presentation. So we'll wait for that information to come up. If you want to stick with us, I've got a question for Ken.
I think I can find that information too while we get there. All these things that you could have asked me about, but I'm pretty sure it's in here. There we go.
We got to it, Ken. And I'm somewhat thankful we didn't get to all those other slides.
Wow, yeah, I was going to say.
Even though it would have been incredibly interesting, I'm sure. So, okay. Ken, the question I have is the same one I asked at the end of our previous webinar. And it's just this. Anything that you want to say to us. I've been appreciative of you as a friend, you as a colleague. I'm sure that I listen to some of your week or bi-weekly webinars because of my job. But I typically find them interesting. You always throw in stuff that's surprising, quotes, authors I've never read, some I have read. So I just want to give you the platform for just a second and say, is there anything you want to say to us as we wrap this up?
Well, I think probably what I'd say is what I say to myself. I think the amount of news and noise and everything going on every day, especially in a high pressure period like we're in. Think about virus, economic activity, throw a very contentious election into it. The likelihood is that we're all feeling a lot of pressure. And some of it's, I think we consciously feel it. Some of it's quite unconscious. But the idea that we're not under pressure, emotional pressure, I just think, we are under emotional pressure. So as you think about all that, it helps me sometimes to look back historically and go, this is not the first time we've had a contentious election. This is not the first time that we've had an economic difficulty. This is not the first time that we've seen a health crisis, right? There are things that we've seen before, we've gotten through, the world has continued. I think there's really lots of reasons to be hopeful that will be the case this time as well. So where we ended the last time was talking about the difference between hope and despair. The person who's hopeful is not naively optimistic, like ignoring the problems. They're just choosing to look at, in spite of the problems, I think we're going to figure out ways to address them and make progress. Despair says, I see the problems, I don't see a way through them, and I just kind of shut down. My thoughts are, and this is after being in politics myself, seeing like you people on both sides of the aisle, by and large, Americans who are engaged, they want good things for the country. We want good things for each other. We're going to work to that end. I just think let's find those people. Let's partner up with them. Let's figure out ways we can do things together, and let's keep going forward. And along the way, let's remain optimistic about our ability to do these things. And I think, companies, the economy, even the government, as hard as that is to be or believe sometimes, can actually function at a higher level. And so why not work for that as opposed to giving up on it?
Thanks. And even though I had one last question, we actually have a viewer who
Great. Awesome. I hope they hung around.
Wrote in a question. And they asked this: with a potentially split government, do you see an income or business tax rate increase within the near future?
So the last part of the question, within the near future, I'm not sure that even if we had a kind of that blue wave result, that we would see a business tax increase in the near future.
Right.
Because I think until we get on the other side of the kind of this virus economy and the slowness that's happened there, everybody's kind of looking at it going, we need to remain, easy money, stimulative on the fiscal side to get everything kind of through and running. Now, if the Republicans remain in control of the Senate, if they have the majority and Vice President or now President Biden, let's say he wins, like it seems like he will, the House will be controlled by Democrats. The House may propose tax increases. The then President Biden may say he would sign tax increases.
Yeah.
But ultimately, it's got to go through the Senate before it gets to the president's desk.
Yeah.
And I find it really unlikely that happens. Could it happen a little as a result of some other kind of compromise? Possibly. But my sense is that there'll be little appetite for tax increases out of the gate if we're in a split situation.
Yeah.
So, and again, because the virus, I think, has kind of taken a back seat a little bit to the election here recently, it's going to come back to the fore. And the real economy is going to come back to the fore too. And people are going to say, we have to address those things. And we don't want to slow down business activity by, one, creating uncertainty and then putting a drag of additional taxes. Because one of the things that has happened the last couple of years, whether you like the tax decreases of the Trump administration or not, there have been corporations who have kind of relocated, redomiciled back to the United States because now our corporate tax rate is a little bit lower than the average tax rate in countries around the world. To go back above average, maybe way above average, would seem to be backwards in terms of attracting the businesses back that we want. Yeah. Mm-hmm.
All right. Well, again, thanks, Kent. And thanks to all of you who joined us today. Have a good afternoon.
Thank you, everyone. Bye.